Here's what happens when you combine two trading strategies. I'm going to be giving you what is otherwise known as the Holy Grail in trading. It isn't a magical indicator or anything ridiculous like that. It's a practical and useful thing that even hedge funds use to improve their returns. Now, if you don't know my background, I run a portfolio of 10 futures algorithmic strategies, and what that primarily means is that they have automated entry and exits, meaning I do not touch the computer for those orders to be executed and for those returns to be made. And in this video, I'm going to be going over why I run 10 futures algorithmic strategies and not just one. And to pay respects to the person that actually coined calling it the Holy Grail is primarily Ray Dalio. He created an amazing video on diversification, and that's going to be what we're typically talking about in this particular video. But give me just a second. It's not going to be the classic bond and stock split. I'm talking about something that's actually applied to strategies and actually can help you, whether you're a day trader, automated trader, systematic trader, whatever you're coming into at. So I'm going to be doing this by displaying a quick and simple demonstration to get you started on the right path. So if I just show you here, this is going to be a very simple strategy. I'll actually just zoom in a bit for you. So it's going to be using RSI. It's a very, basic cookie cutter strategy. We're just going to be longing below 30 RSI and shorting above 70, and we're going to exit on the opposite signal. I'm just going to make my camera a bit shorter here for you so you can kind of see the whole page. Now, where are we going to apply the strategy? Well, it's going to be on futures contracts. If you've never heard of futures contracts before, primarily it's like indices, and it can also be other instruments. So for this particular example, this is going to be applied on ES, which is like SPY, NQ, which is NASDAQ, CL, which is crude oil, and GC, which is gold, and maybe we'll do a couple more, but these will be the main ones we're going to apply to. Now, I want you to focus on this being a very simple strategy. I'm not trying to advertise here that this is going to be some strategy that's going to out-return SPY by a crazy amount or anything like that. I just want to show you the power of combining strategies. And to do this, I think just combining two is a really easy way for you to understand the principles of it and also give you a really quick guide to it. So I ran a back test from 2010 to 2025, and these were the results. So as you can see, if I just zoom out a bit, we can see we were running with just one contract per instrument, and overall it returns, I think, just about $400,000, give or take, over that 15-year lifespan. Now, the compelling aspects of this just simple strategy is, while even despite its simplicity, it achieved a total return of 197.53% based on just using one contract. The maximum drawdown was about 24%, and that was over a 15-year period, showing decent capital preservation compared to beta. So beta is what you'd be comparing it to, such as like SPY. So that is the underlying thing we normally compare it to, as the SPY, like S&P 500, is normally what most benchmarks are made against. Obviously, there's also a benchmark called risk-free rate. So that is like bonds, for example, or just high interest savings accounts. That's kind of the risk-free rate where you're not actually risking anything. It's just a paid amount percentage to that. So I think currently right now it's about 4 to 5%. I might be a bit mistaken on that. And it's also great to see that it successfully navigated through the 2008 crisis and the COVID crash. We don't see any huge, devastating fall or anything like that. Obviously, it does go into a bit of drawdown, but overall it still recovers up until, current date. It had a 7% CAGR. What a CAGR is, it's just the compounded annual growth rate. So it's primarily how much each year it's returning. So as you can see here, it's 7%, which is below the average SPY returns, which some argue about this, but it's around 9 to 10%, give or take. So it's still underperformed, but we're not looking for this single strategy to outperform right now. This is just a simple demonstration of how the power of combining two can actually lead to greater returns. Another great thing was that 80% of the years were actually profitable, so that's great to see. But now let's actually combine this simple strategy with a simple trend following strategy. Now, why did I pick a simple trend following strategy? Well, typically this RSI strategy would be considered as a mean reversion strategy. If you're not too sure what mean reversion means when price gets extended, we're taking a short, which then hopefully we're looking for it to revert back to sort of the fair price or the mean. The fair price could be many different things. Some people consider it like VWAP, EMAs, things like that. And if it goes too far below, let's say that EMA, then we're going to be taking a long and hoping for it to revert back to that fair price. So this would be considered more of a mean reversion strategy compared to what I'm going to be adding it to is a trend following strategy. So a trend following strategy is just trying to catch longs along a trend. So as you can see, this is an upwards trend. And let's say it tried to catch one here on the break of these highs and like one here. That's just a very simple example. So if we look below, we can see instantly that the equity curve is a lot more smooth. We can see it's kind of grinding upwards. We can obviously see that's a lot more fleshed out because there's more trades because we're combining two strategies together. And we can see the total returns is a lot higher. We can see it's around, a million, give or take. If we actually look at the returns, if I just scroll down here, the total returns was 248%, 50% more returns by just adding one more strategy, primarily creating a portfolio now of two strategies. Now, why does this combination approach work so well? Well, when we pair strategies with different characteristics, we tap into one of trading's most powerful principles, diversification. By looking at the combined equity curve, you'll obviously notice, as we just gone over, that the high returns, and we also have a higher CAGR, which is very important. It's 8.11%, so about 1% more than the 7% CAGR previously. Next, we also had reduced drawdowns. This is very significant, at least in my particular opinion, because I prefer to try and reduce the drawdowns as much as possible. I don't mind lower returns technically, as long as I have very controlled drawdowns. And this reduces the drawdowns to 13.85% compared to 24%, which is a very big decrease. Overall, this leads to more consistent returns across even different market regimes. Now let's get into why this works. Just a bit more in detail, but I'm going to keep it very simple so you fully understand everything. Well, first, we have the kind of previous point I talked about, right? It's the strategy offset. So when one approach struggles, the other one normally compensates. For instance, during choppy markets, our first strategy might underperform, but mean reversion strategies would typically thrive in these conditions. My apologies, I meant to say that the first strategy would probably perform the best because it's more of a mean reversion strategy compared to the second strategy that would underperform. Next is the risk distribution. By spreading capital across uncorrelated, that's the very key point with this, is it has to be uncorrelated. I'll explain that just a bit more in a second. We're not overly exposed to any single market condition. Otherwise, if they were all very closely correlated, then we're kind of just trading one strategy. I'll get to that in just a second. And lastly, we have the psychological edge. So combined strategies often make it a lot easier to stick to a systematic approach. When one strategy is in drawdown, others might be performing really well, helping maintain clear mental decision making. A really great example of this is if you look at my previous video, I think it was my February trading recap, I had around 4 strategies completely underperform, meaning they were actually losing me money, but one particular strategy that month outperformed all of the others and made it still a profitable month for me. If I had only been trading one of those strategies, and let's just say it was an unprofitable one, that's a lot harder on my psyche compared to having, let's say 8 strategies that are running and one of them is performing really well, making up for the losses of the others. Now, in case you're not fully aware of what uncorrelated means, to give you a very simple explanation, let's say we had 2 markets, we had red and green, and if they were both trending upwards, then they are correlated, especially if both of them also move down together as well. So let's say they had a turn and they both move down together, they're kind of correlated. So think about ES and NQ. They're quite closely correlated for the most part. But what we're looking for is uncorrelated approaches. So realistically in markets, you're never going to get fully uncorrelated. It can happen. You can have negative correlation, but consistently over, let's say 10 years, that's quite difficult to achieve. But you at least want low correlation, meaning that if you have 2 strategies that are performing, let me just rub this off real quick. If we had 2 strategies and they were both in line together, so they were both having a very similar equity curve, if one of those strategies stopped working, let's say because of market conditions, it's very likely that. So ultimately, you're actually just trading one strategy because if the market conditions change and they both revert to losing money, you're basically trading like a 2-levered position on that particular strategy because you're just running with 2 of them. So it's basically the same as just running one strategy. Whereas if they're lowly correlated, we could see, the green one do really well, whereas the red one doesn't do as good and is kind of more flat during that time. That is kind of a low correlation, meaning that if the green one suddenly starts to fail, meaning that it's losing money in that current market regime, we wouldn't expect the red one to completely do that as well, which means maybe the red one will actually pick up because they're sort of opposing or different characteristics, like we kind of gone over here with trend following and mean reversion. I hope you excuse my very kind of shoddy drawings with them, but hopefully that sort of explains it in a simple manner. Now, the beauty of this approach really lies in its scalability. As you add more uncorrelated strategies, your portfolio becomes increasingly robust, as long as each addition is properly tested and truly uncorrelated. As we can see here, here's a graph from kind of Ray Dalio's depiction of the Holy Grail. And as you can see, once you add more assets, the correlation or the annual portfolio standard deviation decreases. And that's what we're really looking for. In this case, we're just more applying it to actual strategies instead of the amount of assets. Now, on a very important note, you do not need to implement everything at once. You don't need a portfolio of 10 strategies running instantly to get any benefits from this. You can start with just 2 to 3 strategies, even just adding one more strategy to your current one, as long as it's sort of uncorrelated or lowly correlated. Then you can gradually expand from there and still get huge benefits from diversification. Most of the diversification benefits do appear actually quite early. So you don't need hundreds of strategies to see meaningful improvements. And it is a bit of a diminishing returns sort of effect, meaning that if you had 100 strategies compared to, let's say, 99, the incremental benefit of that isn't going to be that much. But compared to just 1 to 2 strategies, there's a huge benefit there if it's properly tested and actually uncorrelated. The beauty of this approach is that it's actually more achievable than trying to build the perfect strategy. In my experience from 5 years of trading, I've never seen a strategy that conquers all markets, is perfect in all market regimes, works on every time frame, etc. It's just not really possible. So it's actually very relieving that you don't have that expectation that you need to make one perfect strategy that's always working, always making you money every single day. It's profitable. Those things just don't really exist, and people advertising you those are just trying to normally sell you something. Because realistically, most strategies will go into a drawdown. That's totally fine and totally manageable. But by adding this sort of approach where you combine strategies, you can try and stabilize your equity curve because you have those uncorrelated approaches. Instead of chasing perfection in one area, you can be good in several areas and let the math of diversification work in your favor. Now, before you can add more strategies to your trading, you will need 2 crucial skills: the ability to properly backtest each strategy and the knowledge to accurately measure the correlation between these strategies. Without these, you'll probably have some costly mistakes like I did during my journey. Now, I won't get into all of these in this particular video, but I will expand upon these in later videos. If you do want to work with me as well, then I can obviously discuss that with you and kind of building out a portfolio. And yeah, I think that's about